No? Okay, welcome everyone. This is a live recording, so everybody just be aware of that, but we won't be training the camera on you at all. I'm delighted to be here for a discussion we have every Thursday evening anyway about markets, but it was a great privilege to be able to invite Brittany Lewis along because it was actually Deb Dubin introduced me to Brittany, I believe at one of your events, Linda, and we had a nice conversation about your subject area and financial regulation. And given coming to St. Louis anyway, I thought it'd be great to invite along a guest. And this is actually the first guest we've had on the Markets Happy Hour podcast. So it's a nice first there. And I thought what I do for this format is I will just have a quick 5-minute run through markets before we launch into a discussion with Brittany. Brittany's area of focus is financial regulation and particularly unintended consequences of that. So given that we are all focused on what may be a tailwind of financial regulation with the incoming, with the new administration, a tailwind for financials. We're expecting it to be perhaps more lenient and more pro-business, more business-friendly, pro-growth. We will see what that means. And we're also going to look back at some previous regulation to see if that had the effect we thought. We're only here for a half an hour, so it is going to be quick. But we'll come to Brittany in about 5 minutes. I just want to set the scene first. And I'd love people both online and if there's anybody in the room who'd like to ask questions. These are always, this is our third live event now. And they're so much better when they go off track and descend into the discussions that you enjoy. So let's just quickly kick off here in terms of what we tend to cover in the Happy Hour podcast. What we'll generally cover would be just going around the market pointers. So inflation, interest rates, geopolitics, equity markets, what's just happened in this last week, what that might mean for your positions in your portfolio or else, and what may be on your mind and your manager's mind. So we just get from that. I think it's fair to say that it's February is coming along in Saturday, and it's February the shortest month after what has for most of us felt like the longest month. I think January is always a tough month, but this one in particular has been filled with unexpected events, made money from left field. The first, I think, was the Los Angeles fires, the devastating damage there. And the fact that was, despite being anticipated through weather, nonetheless took a lot of market participants by surprise. We then had the inauguration. We had a flurry of executive actions, truly, I think, drowning in paper and in statements and policy, and not clear, again, what they could make of that. We had U-turns in terms of interest rate direction. We saw interest rates look like they were about to never fall again and rise. And then we looked like, because inflation was in check, they would fall on track. But we're still quite a bit subdued in terms of our expectations for interest rate cuts. We think inflation's in check, but we don't know what is up Trump's sleeve when it comes to tariffs. And that could, of course, throw all of that out of whack. So we have quite a bit of uncertainty there. And then I'll add to that the events of this week, which were, again, another left field surprise in the form of Deepseek over the weekend, revealing that they had an open source competitor to AI, and that this was likely to be cheaper with cheaper chips, skipping many of the steps. And this, of course, was the equivalent of an earthquake around some of the big tech stocks. So that was what we would call a left field surprise. But we could ask the question, was it a surprise? Should it have been a surprise? Had we become so carried away in the hubris of the big tech dominating that we didn't actually take into account that there could have been a cheaper competitor out there? And why should this have been such a shock to markets? So again, very relevant to our discussion of the law of unintended consequences. I think the other unintended consequence of this Deepseek reveal was the fact that it wasn't just the big tech stocks that were affected. It was actually the adjacent sectors like energy, that have perhaps been rising significantly as adjacent to the run in tech, the expectation for demands for energy. I personally think we are going to see ongoing surge in demand for energy, regardless of whether we have expensive or cheap chips for AI. So I don't think that necessarily should have taken a hit the way it did. But what we can see in this chart here is that the comparing, say, Vistra, the energy supplier to many of these data centers, to NVIDIA, that actually Vistra underperformed by more than NVIDIA over the course of this particular dip. So again, a lot of factors in there, remembering that tech stocks are seen somewhat as a flight to safety at the moment, whereas energy and defensive has been less popular for some time. So if we think about when there is a sell-off, it's actually been the value stocks, the defensive stocks, the mid-cap, the small-cap sectors have sold off by more than the large cap, even though it's large cap that arguably is more frothy. And then is this a hint of what's coming? We've had the naysayers, the doomsayers like Nassim Taleb suggesting that this kind of a rout is something that we should be expecting going forward. So quite a bit of an unsettling start to markets that were already to the week that were already feeling it with the post-inauguration flurry of orders. I'd say again, this is something that's come up time and time again with our client meetings, has been the narrowness of markets. And we can see now that basically we are in really quite extreme conditions when it comes to narrow outperformance. What are the stocks that are driving markets? These are the things that remind us that markets really are poised and priced for perfection and perhaps poised to fall if we have a left field event like that. So another reminder of just that we are in positive equity markets. We've had these 2 years of very strong performance, but we don't necessarily know if that's here to stay. And we probably are pricing in too little volatility because equities have shown such little volatility compared to fixed income. I'd say the other piece of news this week, besides the tragedy last night, was the discussion of the Fed, and they're in no hurry clearly to make any change to rates. That was as expected. No change was expected, but we can see that they're pretty happy with where things are going in terms of the economy, in terms of inflation. And I just say that this is quite a stark difference from what we're seeing around the world. And even this week, we saw the Bank of Canada cutting rates. They're saying in the case that tariffs, in their case, could stoke persistent inflation, but they still need to cut rates anyway, because clearly they could be under some pressure economically. And then the ECB did cut rates again today. Clearly, they're also poised to cut again in March. And that's all stacking up for their last attempt, perhaps the last attempt to stimulate those economies which have not been able to participate in the growth that we've seen in the US. I'd say the sentiment around the euro in particular is bearish. If we look at what's happening with the dollar, we can see that the dollar has been resoundingly positive. And when it comes to the Trump's policy, certainly he would like a strong dollar. It very much aligns with a strong America first image. And certainly if we think that American as a reserve currency, we're not hearing at all about debasement and no one using the dollar. So the dollar, with rates being held and these other rates being cut around the world, certainly your clients on their heading off on their European vacations this summer will be enjoying the benefit of a strong dollar, and that continues. But I just want to leave with this point about, is now the time to buy bonds? Watch the White House, not the Fed. So it's really interesting. Where is the tail wagging the dog at this point, or what's controlling what? We have a particularly active White House and executive branch at the moment, far more active than the tail end of the last administration. We have a vigorous press conference, this combative nature. But the new villain is DEI. We were talking about this. I don't know how long it took for that to be linked to the tragedy last night, but it seemed to be linked even in the first few hours. I do think, though, that perhaps the journalism has been a little bit misleading in that particular respect. But we have a Fed which is pressed to be independent. We know the chairman is staying in place, but we also have a president who would like to see rates going a lot lower, regardless as to what that may mean for inflation and otherwise. And then just the latest piece of news, because it's hard to stay up to date with compliance checks on slides and news flow. It looks like tariffs are coming on Mexico and Canada this weekend. So whether that's an attempt to, it seems, redress a deficit that's been in place or a subsidy, there seems to be quite a bit of turmoil and news flow there. So we will certainly be watching that with interest. So now coming on to our guest of honor, and Brittany, thank you for your patience sitting through that the rattle through, but hopefully that set the scene as we launch into markets today. So your resume is here, but just in terms of your areas of expertise, banking and financial institutions, finance, investments, and financial economics. And what really whetted my appetite to speak with you was your work on regulation. So maybe now, after that introduction, you can tell us a little bit about the research you do on financial regulation and what that has told you maybe about financial regulation and how it works.
Thank you so much, Aven. It's great to be here. I'm super excited to be here at Moneta, and that was a wonderful introduction you gave. I also learned quite a bit about the market since things are changing quite a bit just with the things you told us now. but I'll stay more closely in my wheelhouse, which is financial regulation, as Afen said, in the unintended consequences. I'm a professor at Washington University, St. Louis, so just down the street, and I study the intersection between financial intermediation and household finance. Specifically, non-banks are really my area of expertise. So just to kick off and sort of weave in with what Afen was telling us, what we're seeing coming down the pipes with financial regulation is we did see a freeze on federal agencies hiring. So that means that the FDIC and other federal regulations are not able to hire any new workers for the next coming months. The Federal Reserve is not totally does not have to abide by that because they're not completely a federal agency. However, they did just announce that they're going to follow the executive order. So freezes on Federal Reserve employees are in place, or new hires, I should say, are in place now for the next coming months. What that means from a financial regulation standpoint is likely some deregulation or slightly less oversight. So I'll use that as a jumping point to transition into kind of what we saw with SVB, what we can think about going forward, where the areas people are concerned about are, and whether or not we should be expecting sort of like a 2008 style crisis. So I want to first just set up the stage for SVB on a very high level. So what SVB was doing was they were investing quite a bit in long-term treasuries. Long-term treasuries are very sensitive to interest rate hikes, and they happen to be heavily invested in long-term treasuries at the time the Federal Reserve was raising the rates very steeply at the beginning of 2023. So another thing that they were doing is they were heavily taking deposits from tech companies that they were funding, which meant that they had very high levels of uninsured deposits. So this disconnect between the value of their assets and the value of their uninsured deposits was what caused the run, because what people can do, what investors could do, and deposit holders could do is they could just download the bank's call report, which is essentially their balance sheet online. They could see what their treasury holdings were, and then they could get the price of the treasuries, and they could tell what the value of the asset portfolio was, and they could also tell what the liabilities were, and they saw that there was not enough value in the assets to match the liabilities, and they ran. Then the question was, should we bail out SVB or not? I mean, the FDIC decided to bail out that SVB, but an argument could have been made that we maybe should not have bailed out SVB because it potentially was not as critical to the financial stability as what happened in the global financial crisis. So my work actually carefully looks at the global financial crisis, and I am trying to debunk sort of the myth that we don't necessarily know what happened in the global financial crisis. I think we know quite a bit about a large contributing factor. So what happened was the Congress passed a policy change called the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005. This is about a 300-page document. 299 pages were all about consumer finances. So if any of you declared bankruptcy, how would your assets be treated? One page changed the definition of repurchase agreements. It specifically granted preferred bankruptcy status to private label mortgage loans, mortgage-backed securities, and interest on mortgage loans and mortgage-backed securities. Now, private label mortgage-backed securities or mortgage loans means risky mortgage loans. These are not agency-backed, they're not conforming mortgages. And what this preferred bankruptcy status did is it meant that the ultimate creditor could take possession of the collateral outright if any counterparty failed, and they could sell it in the market in order to try to be made whole. And so just to back up, what funding markets am I talking about? I'm talking about the sale and repurchase market, which is typically known as the repo market. And this is an important funding market because it funds non-banks. So about 50% of mortgages nowadays are originated by, let's say, the Quicken Loan, which is a non-bank. So they don't take deposits and they receive lines of credit from dealers via repo. this repo agreement fulfills the same economic function as a collateralized loan. So basically, when you think of a collateralized loan, a company would go to a bank, they would pledge collateral, and they would take out a loan which was backed by that collateral. If the company declared bankruptcy, then the bank could take control of the collateral, they could try to sell it, and they would use the proceeds to make themselves whole on the money that the company was not able to pay. Now, a repurchase agreement fulfills the same economic function as a collateralized loan, except it takes the form of an outright sale of collateral with an agreement to buy back the collateral at a specified time at a specified price. So it's basically promising collateral today in return for money, and then a promise to give the money back tomorrow or in a few days and take the collateral back at that time. And this policy change granted preferred bankruptcy status to the collateral that was used in these transactions. And what this meant was it meant that the ultimate creditor had super senior bankruptcy status. And if any counterparty failed, the ultimate creditor could take immediate control of that, and they could then try to sell the assets outright in the market to make themselves whole. And so just backing up again, why is this important? Well, this is important because the way the repo market works is you have dealers sitting in the middle of the sale and repurchase market or the repo market, sort of like a hub and spoke model. The dealers are the hub, and then everybody they're lending to are the spokes. And the dealers I'm talking about are Bear Stearns, Lehman Brothers, Goldman Sachs, Merrill Lynch. Countrywide was actually a dealer in 2004, 2005. And what they're able to do is they lend to the Quicken loans. So let me pick Bear Stearns as an example. Bear Stearns would lend to Quicken loan, let's just say $100. I know the magnitudes are way off, but they lend Quicken $100. They take 6,000 mortgages as collateral for that $100. And now, because the collateral receives preferred bankruptcy status or super senior bankruptcy status, and because the collateral was outright sold to Bear Stearns can now take that same collateral and they can use it to borrow on their own behalf. So they could now pledge the same exact collateral that Quicken had just given them with Goldman Sachs. And the super senior bankruptcy status is important because now if either Bear Stearns or Quicken declares bankruptcy, Goldman Sachs doesn't care. They're holding the collateral. They don't have to go through bankruptcy court regarding any failures of Bear Stearns, and they don't have to go through bankruptcy court regarding any failures of Quicken. They can sell that collateral outright in the market to try to make themselves whole. What's also important is these repo agreements had cross default clauses built in. So if Bear Stearns had made a promise to both Lehman Brothers and Goldman Sachs, and let's say they prioritized paying Goldman Sachs over Lehman Brothers, if they missed a margin call with Lehman Brothers, even though they paid Goldman Sachs, Goldman could say, no, you missed a margin call with Lehman. I have this cross default clause built in because you are defaulting on Lehman. You're also defaulting with me. I'm going to take the collateral. I'm going to sell it outright in the market. So this policy change combined with the cross default clauses already built in on repos and then the preferred bankruptcy status facilitated runs in private label mortgage, which was risky mortgage collateral, and the runs could happen en masse at the same time. So both Lehman and Bear Stearns could take the collateral and sell it and try to sell it fast before the price dropped too much. Even my work shows that this policy change in 2005, specifically on private label mortgage collateral, is a large contributing factor to why we saw 13 of the largest, most systemic banks fail or become close to failure within a period of 2 weeks in 2007, because the policy change allowed the repledging or what's called rehypothecation of collateral, where you can use the same collateral more than once to back multiple loans. That really increased the amount of leverage in the financial sector, and it really increased the amount of interlinkages. So you had lots of very systemic players, very interlinked with each other. So this was what was going on in 2007, 2008, and behind the scenes in the global financial crisis. Now, Afan's prompt for me was, do we expect to see that sort of thing happen or play out in other sectors going forward? And my answer is not with the current state of regulation. So what people are most concerned with next is the CRE or commercial real estate segment of the market. So commercial real estate has its own risks. Banks are heavily exposed. Small banks are very heavily exposed. And as you guys saw in COVID, and as we all saw, there was a flight away from commercial real estate and towards homes, and people were really worried about this stability of this sector. However, right now, commercial real estate does not have this super senior bankruptcy status in the repo market. It is very true that a lot of commercial real estate is funded by warehouse lines of credit that are done on repo. So it's ripe for the same type of policy change. But as long as Congress in 2025 doesn't say we're going to grant preferred bankruptcy status to CRE loans, then I don't think we would see the same amount of interlinkages, the same explosion of leverage, and then also the deterioration in the quality of the collateral. Because another thing I should say is one of my new papers now shows that after this 2005 policy change, what we did was we increased the types of private label mortgage originations that were originated. So private label used to mean subprime mortgages, which were mortgages below 660 FICO score, but still conforming mortgages, meaning that they, or I should not say conforming, I should say fully amortizing mortgages, meaning that as you paid down the mortgage, you were building equity in the home. So they were standard mortgages, they just had low credit scores. But these were also very expensive by the time we got to 2005, 2006, because home prices were already near peak and interest rates were increasing. The Fed at that time was trying to tighten the market since 2004. So to take out this standard mortgage was actually a very expensive product. So what this policy change led to is it led to an increased innovation in the types of products that were offered. So we started offering the option arms or balloon mortgages, or hybrid mortgages, two-step mortgages, all these mortgages which were negative amortizing, meaning the borrower paid an artificially low introductory mortgage payment, and it would reset in 6 months, 12 months, or 18 months. And I also showed that we originated more of these mortgage products in minority dominant zip codes. So we were offering these mortgage products in majority Black and majority Latino zip codes at a higher rate than we were in majority white zip codes. Now, what this did is it meant that we were going to have correlated payment shocks because you originated a whole bunch of mortgages very fast after April of 2005 when the policy change went into place, and you originated them in correlated demographic groups. So we would have these payment shocks that would hit these borrowers at similar points in time. And this is also decreasing in the background. It should have been decreasing the price of mortgage-backed securities, because we think of mortgage-backed securities as being beneficial because they diversify risk, right? So you hold a pool of 6,000 mortgages, you hold little pieces of each one. Hopefully they're geographically diversified and diversified in mortgage products and borrower characteristics. But I argue that the policy change actually increased correlation of the underlying collateral in terms of the risk of the borrowers, the location of the borrowers, and the types of products that they got, as well as when their payment resets would hit. They would all hit 6 months after April of 2005 or 12 months after April of 2005. So as long as
so just in terms of that, so clearly well-intended policy can have disastrous results because it may be abused perhaps by shrewd financiers who kind of spot a loophole or spot an opportunity and go from there. I'd say we have a sense now that the stress tests that the banks are being put under are robust today. That we certainly feel that the reason there has not been an 08 type event is that the financial institutions, which are at the core of financial stability, are today robust. Because of these stress tests, because of this change of regulation. I'd say my last question to you, just in the interest of time, is what are we missing today? Is there something out there, some other policy change that's been put in place that is leading to this type of behavior that is perhaps subverting the intention of the change and could lead to the next? I suppose going back to Nassim Taleb here back on the slides, what is the next big bang perhaps that could affect financial institutions? Is there anything out there that you think we're overlooking?
So a couple things. One, these dealers in the repo market were brought under bank holding ship status after the financial crisis. So now they're regulated by the Fed. They changed from the SEC regulating them to the Fed. So that means we're taking a more careful look at their balance sheet. And I do think that the stress tests we have in place are robust. We need regulators to be looking at them. And so that's where the freezes and the layoffs and potentially less regulation, less oversight could lead to more innovation. Also, I think that the current administration may be pro innovation in the terms of having AI solutions. So AI looking at credit scores or AI rolling out products. So that could be a very beneficial thing, but we should also be prepared for unintended consequences of innovation in regulated in the financial markets. One other thing that I'm looking at carefully now is small business lending. So we're also going to roll out the 1071 policy change. 1071 is going to increase standardization of bank reporting on loans made to small businesses. Some of my more recent work is showing that increased standardization on small business loans has the it restructures the market, so it may increase credit supply because investors are more able to have transparent security structures. However, there seems to be winners and losers that receive that credit. So what we're finding is that zip codes that have more standard risk profiles are easier to price in the standardized way. They do better, they get an increase in credit supply, but zip codes that maybe minority dominant or low income or have non-standard risk profiles and would benefit from really carefully understanding soft information may lose out and actually get less credit supply. So that might be one thing coming down the road with the 1071 change in regulation.
It's fascinating. I mean, I suppose that is reassuring to hear that there have been some changes that are in place, that maybe these stress tests are in fact working as they said they would. I suppose the other fact point I'd put out there is that the private credit industry, for which we have a lot of current client exposure currently, is what, 3 trillion today, and it is only getting more developed and more institutionalized as an alternative form of finance versus banking. So I suppose that's another reassuring thing, in that we're no longer perhaps as exposed to the same institutions as we were before, and they're significantly less exposed. So I think we're kind of coming close to the end of the time, and we could probably listen to so many topics we didn't get to. I'm just wondering if there are any questions at all from the floor or from anyone online. No questions online? No, great. Well, thank you so much, Brittany, for coming here and giving us actually, I think, a great history lesson in the most clear terms I've ever heard expressed.
Oh, good.
In terms of the history of the financial crisis and the building blocks that led to that. And I think we shouldn't lose sight of the fact that even well-intentioned regulation can backfire when in the wrong hands, or when perhaps not ongoing oversight. And we started with the idea of EOs and the executive orders that have now come in a waterfall torrent. And the effect being that we've shutdowns, we have lack of staffing, we have furloughs, etc., which could in fact mean lack of oversight and even more strained governance. So thank you all for coming and for listening to this to the podcast, and appreciate your time. Thank you.
Thank you so much. Thank you everybody for having me.